Introduction to Consolidations, Chapter 8, Example 8.1. The following is aspects I want you to focus on when we work through these examples. Of course, Chapter 8 looks at the situation where the equity of the subsidiary includes preference shares, and you need to be able to see how that affects your consolidation process. Then the second bullet is something I'm going to talk to quite a bit in these examples. Please make sure that you are able to distinguish between the two and see how it's different. Step 1 is where we attribute to the equity participants any movements in the equity of S. That's where we increased the retained earnings attributable to the owners of P with their portion of the equity of S. That's where we increased NCI with their portion of the increase in the equity of S, increasing those balances. And then as a step 2, when we actually have a dividend declared by S, we have to adjust those balances again for that dividend declared by taking away that dividend income recognized by the parent and then that debit movement to NCI. We will use timelines and refer to the analysis of equity quite a bit, as it becomes very helpful the moment you have preference shares and ordinary shares issued by S. This concept of non-controlling interest, remember, non-controlling interest only exists in the group, so if you want their balance to change, you need a consolidation journal entry. But something you need to look out for is the instances where it's not necessary to write those consolidation journal entries because the balance in your NCI should not change. Look out for that. We'll look at examples with that effect. Then, always important, this will always be true. Each line item, 100% P plus 100% S as your starting point. You have to be able to see how your consolidation journal entries change the line items. In this chapter, there's 3 examples. We will go through a lot of detail in example 8.1. But then in 8.2 and 8.3, we'll just focus on the differences, point that out, and it remains your responsibility to be able to see how those journal entries will affect the line items in the consolidated financial statements. Example 8.1 looks at the consolidation of a subsidiary with preference share capital if no preference dividends are in arrears. P Limited acquired a 70% interest in the ordinary shares and a 40% interest in the preference shares of S Limited, and my acquisition date is 1 January 29. Then they give you the trial balance on 31 December 2010 of each of the companies. We will be doing and preparing the consolidated financial statements for the year ended 31 December 2010. Remember, you need to orientate yourself in terms of how many years have passed since acquisition date. So since 1 January 29, 1 year has passed up until opening balances date, and then you have your 2010 reporting period. So 2 years have passed since acquisition date. Now you can see in the trial balance the investment in the separate financial statements of the parent in S Limited also now includes the investment in the preference shares. 120,000 Rand investment in ordinary shares and 30,000 Rand investment in the preference shares. Now the equity of the subsidiary includes the ordinary share capital and 100,000 Rand preference share capital. Again, remember, retained earnings, you need to be able to identify whether that retained earnings is an opening or a closing balance. I do not have to include that date on a trial balance. How would you know that is the opening balance? Profit for the year is still included in your trial balance. It has not closed after retained earnings yet, making that retained earnings an opening balance. Then the moment we are in Chapter 8, your dividend and dividend information becomes very important, as that is what we're going to use to help us to identify how much of the equity of S is attributable to the different equity participants. So this information down here, very important. We have a preference dividend declared and paid of 10,000 and an ordinary dividend declared and paid of 15,000 Rand. So in Chapter 8, you suddenly also have a preference dividend. Important to know that it's declared and paid, as it has a direct influence on your consolidation journal entries. Before we look at the additional information, something that's important to remember is that when you look at the trial balances of the parent and the subsidiary, you have to make sure that all the transactions that the parent and the subsidiary entered into have been correctly accounted for in their separate financial statements before we can consolidate. So specifically from Chapter 8's perspective, we assume that all the dividends declared and dividend income recognized and all the intra-group transactions have now been accounted for in the separate financial statements of the parent and the subsidiary, that being my starting point from where I can then apply the effect of the consolidation journal entries. We also assume going forward that my preference shares are always cumulative preference shares unless specifically stated otherwise. In the additional information, let's focus on a few things. Bullet 3 tells us more about the preference share capital of S Limited, which consists of 100,000 cumulative preference shares. Now, if you look at the trial balance, you'll see that the cumulative or the preference share capital is measured at a rand amount of 100,000 Rand. That tells you that the shares were issued at 1 Rand each. It's important that you are able to determine the number of shares issued, as that is what you need to calculate your fixed annual dividend. In this example, it is 10 cents per share, so your fixed dividend is calculated as 100,000 shares, the number of shares, multiplied by the 10 cents per share. And that gives you the 10,000 Rand preference dividend, which you can also see on the trial balance. Then they tell you that the retained earnings of S Limited amounted to 7,500 Rand at acquisition date. There were no other reserves and the share capital of S has remained unchanged. Now what you need to know is what happened with regards to this preference dividend. The preference dividend was at no stage in arrears. Why is that important? We are dealing with cumulative preference shares. And for a cumulative preference shareholder, they are entitled to that dividend regardless of whether it has been declared or not. But in this example, we look at the situation where the preference dividend was at no stage in arrears. Neither P nor S declared any ordinary dividends during 29. Remember, you are not able to declare an ordinary dividend unless you also declare the preference dividend. But you are allowed to only declare a preference dividend without also declaring an ordinary dividend. Then if you look back at the trial balance, you can see that there were actually ordinary dividends declared during 20x10. P Limited chose to measure the non-controlling interests in the ordinary shares at acquisition date at their proportionate share. Remember, the moment we have preference shares also included in the equity of S, we have 2 at acquisition consolidation journal entries, and we need information to measure non-controlling interest in the ordinary shares and the preference shares at acquisition date. The fair value of your non-controlling interests in the preference shares was given as 65,000 Rand. Remember, if you refer back to the effect of the preference shares on the consolidation process, your NCI in your preference shares can only be measured at their fair value. They do not have any right to a proportionate share of the net assets of the subsidiary on liquidation. Then it's the accounting policy of B to account for investments in subsidiaries at cost in its separate financial statements. The fact that it's the parent's accounting policy to account for investments in subsidiaries at cost in its separate financial statements tells you that those two amounts on the trial balance of the parent, the investment in ordinary shares of 120,000 Rand and the investment in preference shares of 30,000 Rand, represents the consideration paid at acquisition date, as that represents the cost of those investments. Just a quick note at this point. In this example, the parent has an interest in the ordinary and preference shares of the subsidiary. It's not necessary for the parent to have any interest in the preference shares. Control is determined with reference to the ordinary share investment. And if the parent does not have an interest in the preference shares, all of the equity attributable to the preference shareholders of S will be attributed to your non-controlling interests. If we follow the consolidation process, step 1 is to adjust anything that's necessary in respect of differing reporting dates or accounting policies, which is not necessary at this point because the accounting policies of the companies are identical and they have the same reporting date. We combine the balances and totals, giving effect to 100% P plus 100% S when we present the actual consolidated financial statements, and we still do not have any business combination valuation journals as we have not yet looked at Chapter 7. Now, before I go into the detail of the consolidation journal entries, I would like to use a timeline to illustrate what happened in this example.